Time to lean into the growth upturn. Joining me here, post 9 to explain, Gabriela Santos of JPM Asset Management. Nice to see you back.
Nice to see you, Scott.
So that's a big statement, uninvestable to unavoidable. Have we really gotten there?
So I think for the past 2 years, uninvestable had become a bit of a buzzword. We're talking about China. We had a 60% correction in the equity market. Interest rate differentials started to turn in the U.S. favor. So really the rewards weren't worth the risk of thinking about a China strategy. And if anything, there was a bit of a liability in having a China line item in a statement. Mm-hmm. I think this year, with the 60% rally we've seen off the October lows and with this massive growth upswing that we're expecting in China's economy and earnings, it's unavoidable to at least have a strategy about China. Whether ultimately that is investing directly in China, as we would argue, we would be overweight Chinese equities, or whether it's playing that story indirectly through Southeast Asia or certain European companies, you've got to have a strategy.
A better market performance, reopening doesn't change the lack of trust issue, which some investors still have no matter what happens. How do you deal with that?
Yeah, and we recently released our new guide to China, and there we make the argument that there's a very powerful story to invest in China. It's the reopening. It's also the broader pro-growth turn that China has taken, which usually tends to last a couple of years. It's also the expectation that there's a lot of alpha to be added beneath the surface post-initial first wave of COVID reopening. But ultimately, we do still make the case that this is the same China. You still have to have a limit to exactly how much China you can add directly, because it will continue to come with double the volatility. And for some clients, ultimately the decision is not to invest in China directly, to play it more indirectly through other emerging markets or even developed companies like Europe.
Okay, so let me ask you that. Some of the neighbors, if you will. Do I feel like I can get similar upsized returns with lower volatility and lower risk by playing the region, just playing it elsewhere, and I don't have to worry about some of the regulatory and other issues that are out there? And I just bring up what JPM CEO Jamie Dimon said last week. The thing I worry most about is Ukraine and our relationship with China. That is much more serious than the economic vibrations that we all have to deal with on a day-to-day basis.
And I think we'll continue having this underlying vibration over the next century, which is a mix of competition, at times diplomatic tension between the U.S. and China, which ultimately means there's a certain level of volatility or premium that should be associated with investing in China directly. When it comes to public markets, something that's liquid, you can get in and out, that's less of a concern. Where we've seen some changes from our clients is more in terms of private markets, where there is liquidity and a longer-term horizon. When it comes to playing China indirectly, I think the reopening theme, yes, you can access with other EM countries, which by no means don't have issues of their own. But certainly you can play the reopening theme, the return of Chinese tourists through Singapore, Thailand, Vietnam, Korea, and developed countries like Japan and Europe.
So I had a guest, I don't know, within the last couple of weeks who has a similar thesis, and you alluded to it earlier by just playing the European luxury brands. Yeah. That's the easiest and, if you want to say, safest way to do it. Now, I know you don't pick stocks per se, but that's the basket that you would be looking at?
So the indirect way to play China is through the return of Chinese consumption. And European luxury companies derive 40% of their revenues from Chinese consumers alone. And there's a big benefit of Chinese consumers being able to go back to Paris, Rome, Milan. They don't need to pay taxes like they do when they buy those luxury items domestically.
Right.
So that's an interesting opportunity, and we don't feel like that's fully priced in quite yet.
Let me turn your attention to here at home. U.S. markets, 13 days that are especially critical. That's how we've been kind of thinking about things today. Beginning tomorrow, Fed chair on the Hill, jobs report, CPI, Fed decision. We've had a couple days move here in the market that's made people feel a little bit better. How do you see it?
So I mentioned, and we started off talking about China because there we do have a conviction on the turn in the macro direction, something that can carry us over the next couple of years. And it was reiterated at the National People's Congress, a focus on growth. In the U.S., there's much less visibility on the cyclical macro picture. Every client we speak to has very low conviction on the macro picture.
Right. Every guest we speak to, by the way, is very similar.
Exactly. And there's just a certain lack of humility we need to have when thinking about all of the different possibilities and elevated probabilities we have in the U.S., soft landing, hard landing. So within U.S. equities, we don't feel like it's the time to be taking a big stance, and that's underweight or overweight, by the way. Where we do feel like there is conviction in the U.S. macro picture is that a no landing is not a steady state. The Fed will not tolerate higher inflation for longer. And so what that means to us is one way or the other, inflation should normalize. And ultimately, that's why we do have conviction on bonds.
I was going to say, it's a matter of how we get there.
It is a matter of how we get there, which the kind of the journey does matter for stocks.
Yeah, for sure. Well, we're learning it's not linear.